Amazon stock has tumbled over 50% this year. Shares for the online retailer performed at their worst in over 20 years. Amazon lost some $900 billion in market cap. So what contributed to this? Well, during the height of the pandemic, it gave Amazon a boost to its stock as sales soared and people shifted to online shopping from home. But as the pandemic faded and the economy reopened, consumers began to go back to in-store shopping. Still, Amazon performed better than Tesla and Meta. Their shares are down 68% and 66% respectively. And to get a sense of what the tech sector is going to look like next year, I spoke to a portfolio manager at asset management firm Crescat Capital. Thanks for joining me, Tavi. So this year really hasn't been a good year for tech. We're seeing Amazon losing 50% of its value. And you recently tweeted about this as well, this topic. So I want to get your thoughts. Where do you think tech stocks are headed next year, 2023?
Well, I think there are some companies that still have a lot of downside risk, and Apple is one of the I think the main ones, still has a 58% downside risk compared to Amazon, for instance, which is already at their March 2020 lows. And if you look at most of the darlings in the markets in general of this past cycle that we've had, majority of them are already trading at those March 2020 lows. So I think that that's the general roadmap for the overall market. And so that's what I'm expecting. I think Apple is one of the companies that have been sort of holding up this market in the last month or so, despite this weakness that we've had. And so I think that that's the next shoe to drop is on companies like Apple or Microsoft that still have a pretty large downside relative to others. So as far as positioning for our funds, Apple is our largest short position as of today, and we think that there's certainly a lot of opportunities ahead in terms of shorting the name for now. And if I can think of a company that will be even more impacted by, especially the deglobalized trends that we've had, and a company that's really benefited from cheap labor is certainly Apple. And it still is a consumer discretionary, while a lot of people think it's a staple company because everybody needs an iPhone, it still is a consumer discretionary business overall. So I'm expecting that to be catching up with other parts of the market. And so overall, I think technology companies still have a lot of downside to go.
And what evidence is pointing to that?
Well, the evidence is really what's going on with this repositioning in markets that we've had over the last couple, maybe year or so, from the growth to value transition, which I think it's a long-term trend. It also has to do with this issue of a lot of those companies in the technology realm have been, with very large multiples, with growth multiples, because they are growth companies. But when we get into a space where cost of capital is a little larger or higher, which is certainly the case now, you start focusing more on profitability, and profitability of companies is quite different. So let's just say use Apple again as an example. It still trades at about 22 or so times earnings of next year. And that is just a very hefty multiple, given the fact that we don't think the company is going to grow whatsoever in the next 12 months. And, if not, it's likely to contract. So all those factors are playing into this transition from value or from growth to value stocks, which I think that there's more to go, and technology will be suffering from that transition as well.
So Wedbush Securities recently said that there's going to be a surge of possibly 20% in the tech sector as companies, work to protect profitability and as the Federal Reserve winds down. What are your thoughts on that?
It's not my view as of now. I think that there are some technology companies that already came down too much, which I'm not willing to really short. Amazon's a great example. We're not short Amazon at this point, or Netflix or Meta. So I think you want to be selective on the names. So while I'm very bearish in the overall market for the next, call it 2 quarters or so, I do think that there's a risk for repositioning in the very first week of 2023, especially towards treasuries. But that's just going to be short-lived, in my opinion. Technology is a very large part of the market that will continue to deteriorate, in my opinion. And so most of the sort of short-lived rallies that we may see, I think will create opportunities to fund like ours to take advantage and short more of those names over the next 12 to 24 months. So that's kind of the goal. I mean, I think you got to be very selective in general.
All right, great. Thanks for your insight, Tavi Costa, Crescat Capital. Pleasure speaking to you.